One reason it was surprising was we were curious if there was going to be an investor pushback on corporate governance. I mean, when we started
Mhm.
looking at Palantir, it's one of the most kind of extreme examples of the founders keeping extreme control, but also putting in place a structure by which they could sell out of most of their holdings, the three founders, and still keep effective control of the company. So I think that was the biggest question. Were investors, we saw that in WeWork last year. I mean,
Mhm.
that among other things really flipped out investors. They don't seem to care this year with regard to Palantir.
Do you think they respect the founders in this case and kind of their necessary involvement to this company more than they might have in Adam Newman's case with WeWork? Or what do you think accounts for the difference?
That has to be one part of it. I think that's a very fair point. On the other hand, I think there is something about this market backdrop for it that, I mean, there's just this real, excitement about all these stocks and about new IPOs and kind of a willingness to overlook and not pay too much attention to things like this. And, it'll be fine. So I think it's really those two things, the market and, as you said, Kelly, the management team.
It's a great point. If they were bringing WeWork public right now, it'd probably be a very different story. So let me ask you about the public markets sort of route that they're choosing. Why the direct listing? Why not an IPO? Do you think that has much to do with kind of the company just wanting to go its own way, or does it, as in with many of the other direct listings, often it's a sign of, hey, this is a profitable company, or they have other advantages going that would make that a more attractive option?
Well, first of all, they're not profitable. They've been in business 17 years. They're still not profitable. It's not clearly on the horizon, but they did just raise money before this IPO. So it seems like it's a more straightforward path. I mean, one of the differences, obviously, we've only seen two direct listings before Palantir, but they can give guidance. We just saw guidance earlier about where they would go next year. You can't do that in a traditional IPO. You can't talk to investors. I can't go on and watch them do their presentation to investors. Anyone right now could just log in. So it sort of breaks down some walls with investors.
Yeah.
And yeah.
It'll be interesting as well to see how long it takes those shares to open next week. Just that's been one kind of minor technical part of these direct listings, which have otherwise been fairly successful. So I just want to go back to the structure for one more second, because in the case of their president, Stephen Cohen, you say he could effectively control the company by owning just 0.5% of the shares. That's extraordinary.
It's completely extraordinary. And I mean, I covered Snap, if you remember. I mean, they sold shares with 0 votes to investors. But the big difference with Snap was that Evan Spiegel and his co-founder had to have a certain amount of shares and had to keep them. And if they sold down, those special shares would go away. They've taken really extreme steps to have this special class of founder-controlled stock. Through all these different mechanisms, people can drop out of it. And then it gets to a point where they can each own so little and still have this 49.9% control, and, which is effective control of the company. And then the founders who drop out of this class of stock and sell down, their shares then convert into stock that's 10-to-1 voting stock.